Remember the investment event we went to?
Yes, the one with all the ETF booths.
I was always curious about HHIS, so I almost considered buying it when I saw them.
HHIS. 31% yield. I remember that brochure.
I found it on Instagram first.
Yeah, you told me. A guy has it in his $80,000 portfolio. Makes $1,200 a month in dividends. HHIS is part of his holdings.
I had the money. I was almost ready to buy.
But you didn't.
I didn't. Today we explain why. So what is a covered call ETF anyway?
The fund owns a stock, let's say Apple. Instead of just holding it, the fund makes a deal with someone else. They agree to sell Apple at a set price if it ever hits that price. This kind of deal is called a call option. The moment they make that deal, someone pays them cash right away. Say Apple is at $200. They collect $3 per share immediately, no matter what happens after. That payment is called a premium. Think of it like a rental fee. That fee they got paid up front, the premium, that's where the high yield comes from.
So it's like renting out the stock's upside.
Exactly. If Apple stays flat or drops, the fund keeps that premium. That's a win for them. But if Apple jumps way up, they still only get to sell at that lower price they agreed to. Everything above that goes to the other side of the deal, not the fund.
So you get paid now, but you might miss a bigger win later.
Yep, that's it.
And HHIS does this with a bunch of stocks?
Right. HHIS holds Nvidia, Apple, Amazon, Tesla, Microsoft, Meta, and more, each through Harvest's own single stock ETF that already run this covered call strategy. HHIS is one ticket that owns all of them at once.
If the stock jumps a lot, the fund misses out. Can we use real numbers?
Let's do it. Say the fund buys Apple at $200. They sell a covered call at $210, expiring in a month, and get paid $3 in premium for doing it.
So they have $3 guaranteed today.
Right. Now say Apple beats earnings and the stock jumps to $230.
But the fund has to sell at the agreed price, $210.
Exactly. They made $10 from the stock rising to the cap, plus the $3 premium, $13 total.
But someone who just held Apple made $30.
Right. You traded $17 of upside for $3 guaranteed today. In a strong bull market, covered calls act like an anchor dragging behind your portfolio. You get the cash flow, but you leave a large chunk of the growth on the table.
But that's just one trade on one stock. How does that turn into 31%?
That $3 example was just one trade, 1 month. HHIS does this across Nvidia, Apple, Amazon, Tesla, Microsoft, and more all year long. Stack enough small payments together and the number gets big fast.
Okay, let's use real numbers. If I put $10,000 into HHIS.
At 31%, you'd get about $3,100 back over the year. Paid monthly, so around $250 a month.
That sounds amazing.
Here's the catch. Not all of that $3,100 is new money. Some of it is option premium, which is real profit. But some of it is return of capital, meaning the fund is just handing you back a piece of your own $10,000 and calling it a distribution.
So I'm not actually gaining 31%.
Right, you're getting paid, but part of that payment is just your own money coming back to you in smaller pieces. Harvest says this themselves on their own website. If the fund earns less than what it pays out, the difference is return of capital.
So the real $10,000 sitting in the fund shrinks.
Exactly. Hand back enough of your own money every month, and the value left inside the fund gets smaller over time.
But if the market crashes, that premium cash is a cushion, right?
It is, but it's a small cushion against a falling piano. Back to our Apple example. It's at $200, you collected your $3 premium, and then a recession hits. Apple drops to $150. You still keep the $3 premium, So you're down $47 instead of $50. Technically, you outperformed the regular stock by $3.
But I'm still down almost $50.
Right, and here's the actual trap. At $150, the fund still has to write a new covered call to keep paying that huge yield. So they write one at, say, $160.
So if the price climbs back to 200,
They're forced to sell at 160. The fund fully feels the crash going down, but it's capped on the way back up. That's the staircase. You take the full risk of the drop, but you don't get to ride the full recovery. Over a long stretch of volatility, that eats away at the base value of the fund.
but look at the actual chart for HHIS. The fund is doing well. Doesn't that prove it works?
Here's where I want to be careful, because this part actually surprised me. HHIS launched in January 2025 around $10 a unit. It's still around $10.40 today. Since inception, the total return is over 22% a year.
That sounds really good. Doesn't that fight against the staircase thing?
It is good, and here's why. The stocks inside this fund, Nvidia, AMD, Palantir, have been in one of the strongest runs in years. That's carrying the fund. The covered call strategy isn't what's making the money here. The underlying stocks are. And remember, this fund also uses about 25% leverage, and Harvest itself rates it as high risk.
So we don't know what happens if stocks drop.
We really don't. This fund is 18 months old. It has never been through a real downturn. Leverage magnifies losses the same way it magnifies gains. If the AI trade cools off, that 31% yield doesn't disappear, but your capital underneath it could shrink a lot faster than people expect.
So that guy built his whole portfolio around dividend ETFs like this. Would a growth ETF portfolio make him more money?
Over a long stretch, usually yes. Broad growth-focused ETFs, things like XEQT or VEQT, have historically delivered stronger total returns than a dividend-only portfolio over 10 plus years.
But the dividend ETF pays him cash every month.
Right, and that's the part people miss. A dividend isn't extra money sitting on top of your portfolio. When a fund pays out cash, the share price drops by close to that same amount. You're not gaining anything extra. You're just choosing to take part of your return as cash instead of leaving it invested.
So the $1,200 isn't really extra.
It's the same money either way. The real difference is what happens next. A growth ETF lets that money stay invested and keep compounding. A high-yield fund hands it back to you. And in a regular taxable account, that cash gets taxed the year you receive it, even if you turn around and reinvest it.
So growth ETFs usually ring.
Historically, yes, especially for someone who doesn't need the income yet. High yield still has its place for people who genuinely need cash flow, like retirees. But for someone building wealth in their 20s, 30s, or 40s, chasing yield the way HHIS does usually costs more in capped upside and tax drag than it pays out in dividends.
So why didn't I buy it that day?
Because now you actually understand what you're buying. Capped upside, some return of capital, a real downside trap, and real leverage risk, all wrapped in a headline number built to grab your attention.
Not because I got lucky.
Right. It comes down to what you know, not luck. That's the whole point of this channel. We read the prospectus so you don't have to. If you want the full picture on dividend ETFs and why total return matters more than yield, watch this one next.
And if you're still picking your first ETF, watch this one too.
Thanks for watching. See you in the next one.